I'm joined by Doug Flynn, who's the certified financial planner and co-founder of Flynn Zito Capital Management. Doug, good to have you here with us this morning. The S&P 500 down 1.2% for the month. However, the index is less than 2% from its all-time highs. So what most notably are some of the biggest risks to the market that you're keeping in focus and monitoring at this point in time?
So the risks are the same risks we've had for a while. You've got the Fed, you've got inflation, you've got earnings, you've got COVID, you've got politics. Those things are always the backdrop. And that's actually good because you want to have things in the backdrop that make it feel like, not everything is firing on all cylinders. That's when we get a little bit more worried. But with those things as possible problems out there, that keeps everybody from getting too far ahead of themselves, and it allows things to play themselves out. Such as coming out of COVID, getting everybody reopened, getting everybody back to work, which will translate into a higher market for sure from here.
Now, the August CPI, Consumer Price Index, coming in at 5.3% year over year. The increase still keeps inflation at its highest level in 13 years. I want to get your reaction to the data and the reading that we saw earlier this morning come through.
Yeah, so I think that the expectation was that it was probably going to be a little bit higher than it was. There are definite parts of inflation that don't show up in the CPI, but nevertheless, like energy is a big problem with the cost of energy and what's slated to happen this winter with the projected rise of natural gas prices. So that's a backdrop. And so the Fed keeps saying, inflation is transitory. And all that means is that we're going to have this little spike and then it's going to settle down later on. But I'm not so convinced that all inflation is transitory, and there's going to be parts of inflation that are going to be with us for a while. And so, you've got a lot of people coming back to the workforce with the 10 plus million jobs that are open. But right now you had a little bit of a better number, and so that's translating into a positive in the short term for Wall Street. But you have to watch. It's expected that certainly inflation can be there, and then maybe it will settle down next year. And but whether it's going to be the same low numbers it was for the last number of years, I just don't believe it's going to be that low. I think things have built themselves in there now, and it's going to be with us for a little bit longer at a little bit higher overall than it was over the trend the last 10 or 15 years.
So does the CPI data mean that there's less pressure for the Fed to announce tapering next week, or take us through your thought process? How do you think that they begin to ingest some of the economic data that we're getting this week on the front of how it impacts consumers at the end of the day?
Yeah, I think the Fed's always looking for a reason to sort of buy less than it was buying, and that's what they're doing. So some people are saying that that is a form of tightening, but really the only way I look at it is it's a little bit less loose than it was before. We're still very loose. Interest rates are extremely low. That is a tremendous backdrop, and you have the wind at your back there. And we keep saying the Fed and the trend is your friend. So those things, even though it might be a little bit less loose, it's still loose by historical standards. And so you've got a long way to go before you actually start tightening. But so it wouldn't be the worst thing in the world if they lowered some of that purchasing, because look, inflation, if you have it, and it is here longer than anyone expects or higher, they're going to have to do something with interest rates, which means raising them at some point. And they're going to try to push that off as long as they can. And
so in comparison to price increases, can I get your outlook on wage growth into next year and what the real wage growth will look like, considering the impact to the price increases that we have seen thus far?
Yeah, I think you're going to have some wage growth. And part of the reason why is because, I don't know, you could walk down any street and see that there are tons of open positions. They're going to be fighting for the people to come back, and you're going to have to pay more than the next place to get good workers and have them stay, and the demands are higher. So that's going to translate into some wage inflation, which, whether or not they can pass all that down to the consumer in price increases remains to be seen. That we don't know. They might have to, eat some of that to stay in business. But I will say that, you're going to see a little bit of wage inflation there as people compete for all these workers until that works its way through. And that's the beauty of this whole market and the whole economy, is that all the dislocations will eventually work their way through. We're just in a short-term world. We want immediate fixes. And it isn't that simple. It's going to take a little bit of time, but it is going to come back online. People are going to go back to work as the unemployment benefits, go away. I don't know that they're going to get off the couch between now and the holidays, but roll around into the new year and they're saying, okay, it's the dead of winter. I've got nothing to do. All right, let's get back to business. And so I think sometime next year you start to see that work its way in.
The NASDAQ looking to snap a 4-day losing streak. Do you believe that this is an opportunity to get into tech, or do you believe that there's still some more profit taking to be done?
I mean, I still like tech, but I further like utilities and energy. Utilities I've liked since the last time I was on, and it's actually the best performer, and it's still the second worst performer year to date. But those type of areas I look to. I sort of break the S&P into two different categories. Instead of saying the S&P 500, we break it down into the S&P 10, which is 28% of the entire market, and the S&P 490, which is where everything else is. And the S&P 10 is overvalued or sort of moderately valued relative, but the 490, there are a lot of values in there. In fact, more than half of the S&P is down more than 10%. Yet, that's since May, but yet we haven't had even a 5% downturn this whole year. And that's right now, we're in the 9th longest amount of time we've gone without a 5% drop. So eventually we're going to have a 5% drop. And normally we have 2 to 3 5% drops in a year and a 10% drop. So I like to pick my spots. I wouldn't chase. I would look in the areas that sort of have gotten beat down. But if there is a 5 or 10% correction, then yes, some of that cash that you've been accumulating, you should put in, because the backdrop is still very good for the next couple of years, no doubt about it.
All right, Doug Flynn, certified financial planner and co-founder of Flynn Capital Management, joining us today. Thanks so much for the time and the insights, Doug. We appreciate it this morning.